Business models are a pretty fundamental part of an MBA education. Hi, this is Professor Ken Homa. In this session, we're going to do a quick overview of business models. Let me set a scene for you. You're sitting in a job interview, and the interviewer tosses you a softball question just to get the conversation rolling. He looks you in the eye and says, "What's a business model?" Okay, quick. What's your answer? Just pause for a second. What would you say? Cutting to the chase, the answer might be it's how a company makes money. Now, that's true, but most interviewers might consider that to be just a tad glib. So, let's dig just a little bit deeper. In essence, a business model has got two components, a profit model and a customer value proposition. If you're missing one of those two components, you don't have a complete business model, period. Let's dig a little deeper on the profit model side. When constructing a profit model, you're essentially asking three fundamental questions. The first is, how much capital, equity plus debt, must be invested to generate the business flow of profits? The investment required can be considered in chunks: the initial startup capital, the capital required to launch and grow the business, think new plants and equipment, introductory promotional activities and the like, and the ongoing level of investment required to support the business over in time. For example, think depreciation and maintenance of plants. Obviously, a comparable profit stream that requires a lesser amount of investment is preferable to one that requires more investment since its ROI is higher. For example, generating $5 million in profits on a $50 million investment is way better than generating $5 million of profits on a $500 million investment. The second key profit model question is, what's the business cost structure? That is, the magnitude, how much cost, and the behavior of the cost. That is, are the costs mostly fixed? That is, they don't vary directly with sales volume. Are they variable? That is, they do vary directly with sales volume. Or are they semi-fixed? Maybe having some correlation with sales volume, but not being directly proportional to it. For example, a production line may have a finite capacity. When that capacity is reached, another production line has to be added. Well, that adds cost, and the costs do correlate with sales volume, but not proportionally. No, they moved in a step change. The third question asked when pinning down a profit model is, what's the business revenue model? That is, how are revenues actually generated? From which targeted customers do they come? Are all the revenues transactional at the front end when a product is purchased, or are they fully or partially recurring over time? Think leases, subscriptions, and maintenance contracts where part of the revenue flows long after the purchase. Are there any supplementary or ancillary revenue streams? For example, customers buy toner cartridges to go along with their printers. Are there any derivative revenue streams? For example, magazines get paid for their subscriptions, and a number of subscriptions drives the advertising revenue potential. That's called derived revenue. Now, answering these three basic questions, how much investment, what's the behavior and magnitude of cost, and what's the revenue model, largely defines the profit model of the firm. To fully answer the questions, you've got to do three things: characterize, calibrate, and critique. Characterization means describing what the various levels are like. So when does the investment come? What does the cost structure look like? What are the basic elements of the revenue structure? Calibrating means putting numbers against a description. That is, figuring out exactly how it is that the profit dollars add up. The final step is critiquing, and that says, look at the profit structure, look at the profit model, and ask yourself, is it done in the most efficient ways? Are there other ways to do it? And all things considered, is the company doing it well or poorly? Now, even though I'm a marketing guy, I think it's critical to understand the fundamental economics of a business model before analyzing or developing a marketing strategy. That is, to test out the profit model by asking four general questions. First, generally, how do companies make money in this business? How are they doing it today? How are they likely to do it in the future? Second, how does the specific company we're looking at make money? Do they conform to the existing industry models, or do they have an alternative model? What are the critical profit drivers, or CPDs, That is, what are the factors or variables that most impact profitability? And fourth, how effectively are the critical profit drivers being managed? How can they be managed more effectively in order to generate higher levels of profitability? These questions really get to the core of whether the profit model is any good or not. Okay, let's review up to this point. Business models, we said, have two major components, a profit model and a customer value proposition. We've gone through the profit model and have looked at essentially three major elements: investment, the level and the timing, how much and when does it come; cost, how much and what's the structure, fixed, variable, semi-variable; and the revenue stream. What happens transactionally at the beginning when a purchase is made, and what happens over the lifetime of a product. Now let's turn our attention to the other side, customer value proposition product. A customer value proposition is a concise, compelling statement of the relative value that a company wants prospective customers to perceive about its products. Researchers claim that it's exceptionally difficult to find examples of value propositions that resonate with customers. That is indeed unfortunate. In fact, many businesses don't have explicit CVPs, and others have very weak ones. Let's take a moment and look at what makes a bad value proposition. Some are vague and reek of self-aggrandizing puffery. Think of the world's greatest widget. Fact is, customers don't believe it. The companies probably don't even believe it themselves. Second, some simply list the product's features, or worse yet, their technical specifications in engineering jargon, rather than explicitly stating customer benefits in the voice of the customer. Others are not directed at any specific customers, individually or collectively, largely ignore customers' real needs, and include factors that are irrelevant to customers. Others fail to credibly establish meaningful points of differentiation against competitive products, and some lack any sort of visceral content that can win customers' hearts as well as their minds. To avoid the common pitfalls, a strong customer value proposition should specifically address 6 things. First, the intended market. Who are the potential customers in the target market? Do they cluster into strategic market segments? How can a company communicate with them? How can a company connect with them logistically and emotionally? From a customer's perspective, and I emphasize from a customer's perspective, what needs are being satisfied? In customer language, what benefits are being delivered? What job is being done? Can any of the benefits be quantified? Can any of them be monetized? Who are the direct and indirect competitors? Is the product at parity or better on all factors that customers consider important? Are there product aspects that are both substantially superior to competitors and, importantly, considered meaningful by customers? Do customers have bona fide reasons to believe that the claims being made are true? Is there a technical performance justification? Are there objective third-party ratings or references? Does the company offer guarantees or warranties? What are the relevant customer economics? Are there any non-monetary search and acquisition costs? What is the price paid relative to competitive products, i.e. the next best alternative? What are the total costs to operate and maintain the product over its useful life? And finally, the ultimate acid test. The ultimate assessment question is whether potential customers in the target market will be willing to pay for the benefits that are being delivered. Taken collectively, these 6 elements spell out a complete customer value proposition. Of course, the relative strength of a value proposition depends on the answers in each of these 6 areas. For shorthand purposes, we can reduce a CVP to 3 of the 6 Ps. First, people. Who is the product directed to? How many of them are there? And what are the purchase triggers? What are the benefits that a product delivers? That is, what's the job that it does for customers? And how is the product differentiated from competition? How does the price stack up relative to competition? And are customers willing to pay for the benefits that are being delivered? So, at an overview level, there you have it. A business model consists of 2 components, the profit model and the customer value proposition. The profit model looks at the level and the timing of investment, the magnitude and structure of cost, and the revenue stream over time. The CVP looks at the people, who's it going to, what are the benefits and differentiation of the product, and are customers in fact willing to pay for the benefits. Taken together, these components characterize a company's business model and, yes, does answer the question, how does the company make money?